Okay guys, our next topic will be derivatives. Guys, definitely a very lengthy topic. Initially, first 1-2 sessions it will be slightly heavy also, so be prepared for that. But once you understand the basic part of derivatives, the rest of the chapter will be like, it's not very easy, but it's manageable. Means you'll get used to it. So I'm not going to lie about this and all. Very important. And the impacts of whatever we are covering under derivatives chapter, we have to extend that to another chapter called as forex derivatives. So first we'll learn plain derivatives. Already we have covered forex. That forex plus derivative, some 8 or 9 questions are there. So that actually is part of forex only. But when we start forex, usually we take a forex in the initial first day. We start with forex. So by then derivatives will not be covered. So this question separately we have to handle. And then we have a chapter called as interest rate risk management. So there also this derivatives application is there. Keeping all this aside, when you go to FR, we have accounting of derivatives. So if you don't learn what is derivative here, that FR fellow, he won't teach you derivatives again there. Okay. So at that time our focus should be not on learning derivatives. At that time we'll be focusing only on the accounting part of it. So now we have to learn, at that time we have to do accounting. And see sir, when we go to that other subject FR, all the concepts what we are discussing in AFM, all this will be applied there. In valuations, in accounting, everything will get consolidated. There is, see, whatever we are discussing here, not just for this subject, it's for some other subject also. Anyway, now let's first give the introduction to derivatives. See the name, derivative, the term derivative itself means it is deriving its value from something. So how the derivative is defined is, derivative is defined as a contract, and this contract which derives its value from the value of underlying, or some people call it as underlying asset, but underlying should be fine. So prima facie one contract. See, the moment we say contract, where you have to understand is, a single person cannot enter into contract with himself. No? So obviously at least 2 people are required. And once you enter into a contract, if you violate that contract, legal consequences will be there. Whenever you see the term contract, you must understand that there is involvement of at least 2 parties in that, and both the parties must be committed to the contract. In case they don't commit or honor the contract, consequences are going to arise for that. Next. And this contract derives its value. Now, what's the meaning of deriving its value? In what context this particular term is used here is, deriving its value means since you entered into a contract, the gain or loss in the contract. The gain or loss in the contract is called as value. The gain or loss in the contract is derived from the value of something else. That something else here we are calling it as underlying. Now who can be underlying? Actually most of the textbooks they in fact use the word underlying asset. I just wrote the word underlying, but you can call it as underlying asset also, nothing wrong. Now what is this underlying? Now this underlying can be share of a company. So we can enter into a contract, you and me, where a contract whether you will make a gain or whether you will make a loss depends on the market price of the share of a particular company. We can both bet on Infosys share. I'll tell you that Infosys share price will cross 1900 after 3 months. You told that much scene is not there. Bet. If I win, whatever extra amount is there over and above 1900, that you should pay to me. If it goes below 1900, I will pay to you. It's a plain betting contract. That means in this contract, whether you will win or I will win depends on what? Depends on price of that particular share, isn't it, sir? So both of us cannot win. Either only one party will win, and whether he will win or lose, and to what extent will he win or lose depends on the value of market price of one company share. So Infosys share price in the market is deciding whether I have to pay you money or you have to pay me money. This is purely betting contract, and this betting is based on something, that's something we are referring it as underlying. One example of underlying is the share of a company can be taken as underlying. Next, need not be a share, it can be commodity like gold, silver, soya bean. So we can do betting on the prices of gold, soya bean and all. I told you that gold price will rise, you told it will fall. We both enter into a bet. If I win, you will pay me money. If you win, I will pay you money. So whether who wins or who loses depends on what now? Price of the gold. So our contract ka gain or loss is dependent on price of the gold. So this is a commodity based derivative. The first one is share based derivative. Now you can take index as base like Nifty, Sensex and all. So instead of betting on Infosys share, instead of betting on gold price, we are betting on Nifty points. Sir, Nifty will cross 26,000 again in the next 3 months. It's around drilling around 23,000. You said no sir, it won't cross, it will be below 26,000. Bet. So again, whether you will win or I will win depends on Nifty points after 3 months. So Nifty can be used as base or Sensex can be used as base. Next. We can do betting on dollar price also. They are currency derivatives. That is what I was referring it as forex derivatives. We'll cover it separately. We can do betting on interest rates. LIBOR, which stands for London Interbank Offering Rate, MIBOR, Mumbai Interbank Offering Rate, like this. We can do betting on this. That means people enter into contracts based on these underlyings, and depending on whether the underlying price is increasing or decreasing, the parties will be exposed to a gain or loss. Usually the rule is the losing party should pay money to the gaining party. So who will pay to who and how much they will pay depends on the value of the underlying. So our contract is not to give share or buy share. Our contract is to exchange cash, but we are using share, currency, commodity, index points as a base to identify whether I will win or I will lose. So therefore our contract is deriving its value from the value of these underlyings. Are we clear till here? Next. Now if you observe closely, sir, among all this there is something that is common. What is it? There is uncertainty. Our prices will not be constant. They all will dance. Share price changes, commodity prices changes, gold, silver, then prices changes, Nifty points change, interest rates change. So they are subject to fluctuation. Since they are subject to fluctuation only, parties are entering into a contract. Sir, why will I bet if I know that Nifty will not move at all? What's the point of betting? I believe it is moving and I believe that it will move in favor to me. You believe opposite side. So we both are betting. So if two parties are entering into a contract about a particular price to be attained at a later date, that means what? These things prima facie are moving every day. Every day share price changes, gold price changes, currency values change. So on the changes, if people enter into betting contract, that betting contract is called as derivative. To be in a very crude way, that is what it is. Next. Sir, I want to enter into a derivative contract. Now where to enter? Now if you want to enter into a derivative position, now where will you find a derivative contract? There are two places, sir. One is exchange market. The other one is over the counter. Exchange market means See, as you all know, there is listing of shares which creates a secondary market where people buy and sell shares which are already issued by the entity. So daily trading will happen. The share prices will change depending on demand and supply conditions in the market. If some favorable news comes towards the company, everybody wants to buy that share. So the existing shareholder, what will he do? He'll try to sell the share at a higher price. If nobody is willing to sell, then that one or two investors who want to sell, they will demand extraordinarily high price. So obviously share prices daily will fluctuate because of so many reasons. Among this, demand and supply is the major reason. Now in exchange market, like how we can buy shares and sell shares, like that we can enter into derivative contracts on exchange also. So this is regulated by stock exchange. So the derivative products what you enter on exchange market, there is somebody whose rules you have to follow if you want to enter into a derivative contract there. So stock exchange means there are multiple stock exchanges in India, major two stock exchange, one is National Stock Exchange and Bombay Stock Exchange, example. So you have to adhere to these rules and then only you can enter into derivative contracts on exchange market. Now, in exchange market, the contracts are standardized. Contracts are standardized means fixed lot sizes will be there. Means, suppose you very strongly believe that Infosys share price will cross 1800 rupees after 3 months. You want to enter into a betting contract. Somebody believes that share price will definitely fall below 1800. So I am saying it will rise, some opposite fellow is saying it will fall. So we both are having opposite views. So we are capable of entering into a betting contract now. Right now, we both want to enter into a betting contract, but I want to do betting on this, but only on 10 shares. So I want to take risk, either it is gain or lose. I want to face it only up to 10 shares, not more than that. But in the market NSE, they say that if it is Infosys share, you need to play with a minimum lot size of 500 shares. You cannot do betting on 5 shares, 10 share, 1 share, that you can't do. If you are really buying the share, I am not talking about derivative. If you are really buying the share, then there is no problem. You can buy 1 share also. You can buy 2 shares also, provided a seller is there. But derivative contracts, when you come, you have to enter into lots. One contract is equal to 500 shares. So if you want to do betting on Infosys share, be prepared for either gaining or losing on entire 500 shares. And finally, it is not fixed. It depends on each company ka share individual price and how much volatility it is. That and all we will talk as we go deep into the standard later on. Fixed lot sizes. Next one. Fixed maturities. Suppose same Infosys example, I believe that the share price will cross 1800 when after 7 months. You believe that share price will fall below 1800 after 7 months. We both want to enter into a contract. Not possible. At the maximum, you will find contracts only 3 types: 1 month, 2 month, 3 month. 1 year contract is not there. Sir, we both want to enter. You can enter privately. Exchange are not possible. Exchange contract maturities are fixed. Sir, I want to see how much I will gain or lose on, let's say, 3rd month ending. That means, okay, 3 months only we will enter, sir. But in the 3rd month, last day, I want to determine gain or loss. Exchange is not possible. All contracts are closed on last Thursday of every month. So on which date gain or loss is determined, that is already decided. You don't have much scope to do any customizations, tailoring and all you cannot do. All you can do is simply decide whether you want to enter on a positive side or a negative side. You believe that price will increase or decrease based on that. On position alone you can decide. Sir, price I can decide. How can you decide price? Price you cannot decide. Price is already quoted, that price you have to enter. So everything is standardized there. So for example, in the market, somebody wants to, forget about derivatives, somebody want to sell a share. I'm not talking about derivative, normal share. Somebody want to sell a share. I know that a beautiful girl is selling a share. I want to buy share from her only. That's not possible in exchange market. In exchange market, the buyer and seller, they do not know each other. You only can see the prices quoted, the top 5 prices, top sell prices that you can see. If the order matches, exchange automatically executes it. So, a stock exchange acts as a counterparty to the buyer and also as a counterparty to the seller. So, when I sell share, I know that somebody is buying, but I do not know who it is. Sir, later on at the time of giving, no sir, at the time also you won't know. You will not know, somehow their phone number, Insta ID, not possible. Not possible. So it's like, So it will be like you are dealing only with the exchange, but you know there is somebody else on the opposite side, but you do not know who it is. So then how our order matches? How orders are matched is, I want to buy share at a particular price. I'll put that price and I'll release the order. If somebody also releases a sell order at the same price, then it matches, then it gets triggered. I will buy the share, the other party will sell the share. But I do not know who the other party is. Counterparty, we cannot enter into agreements, deals, fixed dates, all that is not possible. Dates in the sense maturity date here. So that is all not possible. Contracts are standardized, the parties do not know each other. Now, in exchange market, there are two types of derivatives. One is futures, the other one is options. So these are derivatives in exchange market. Only these two, sir. Next, coming into over the counter. Over the counter meaning is they are private contracts directly between the parties. That means the buyer and the seller, the parties, they know each other. They clearly sit on a table, sit across the table, and they identify the terms and conditions of the contract. How much of the quantity we want to do betting on, at what price, on what date, everything is decided directly by the parties themselves. There is no mediator there. So here exchange is governing and regulating here. Here nobody will be there. The parties are directly entering into contracts. Now, here examples of over the counter contract is one example you already know. That is forward contract. Forward contract is entered between customer and the bank. The bank doesn't know who the customer is. Bank knows. Customer also know who the bank is. Banker quotes a particular forward rate. Sir, I want little higher rate. Let's sit for negotiation. Possible. That fellow charges some extra margin. Etc. Please remove it. We are having bulk of dollars. So that is, you are charging very exorbitantly. So reduce. Banker will reduce. Then I have a FC receivable at 7 months. I go and ask the bank, sir, I want forward contract for 7 months time. Bank will give you. Bank will not say that I will give you only for 3 months last Thursday. No business. So the date is decided by the parties. Rate decided by the parties. Quantum decided by the parties. So the parties are knowing to each other and they are deciding the terms and conditions of the contract. Here, exchange is deciding everything. Now, what will parties do? They will simply take position. As a party, what you will do in exchange market is, whether you believe that price will rise or price will fall, accordingly you will take a position. That's all you can do, nothing else. Whereas over the counter, you of course, depending on your expectation, you can take a position. But apart from that, you can also decide the quantity, date, lot size, all this is within your control. Now, parties know each other. No, there is nobody required to standardize the terms for us. So forward contract is one example which we have already covered. If forward contract, whatever we have covered in over the counter contract, it is an over the counter derivative which we covered in Forex chapter. This forward contract, when it comes to exchange market, it becomes futures contract. So whatever is forward, that only is futures. Forward futures 100% same. Only difference is forward is entered directly between the parties. Same forward contract, if it is entered on an exchange, it becomes a futures contract. And now that it is traded on the stock exchange, there are multiple utilities of this apart from plain hedging. So hedging also is possible, like how we did hedging using forward contract, here also hedging is possible. Like how we did arbitrage in forward contract, here also arbitrage is possible. Speculation anyway possible. So all these things are possible here also. So we'll see all that. Next. Interest rate swaps. Currency swaps. Forward rate agreements, which are called as FRAs. All these are examples of over-the-counter contracts. Here the parties very clearly know each other. There are more cases if you want to write, if your hands are not paining. Interest rate cap, interest rate floor, interest rate collar, TIA. Stop this creativity, no? Okay, anyway, in this the forward contract is already covered. Remaining whatever are there, these only we are going to cover in IRRM chapter. Interest rate risk management chapter. So in this particular chapter, for now, we are going to cover only futures and options which are traded on stock exchange. Sir, can't we write a call option in, or can't we enter into a call option in over the counter market? Of course, this is that only. Interest rate cap means it's a call option only. Interest rate floor is a put option. Mix of both is collar. All this we will discuss separately, sir. Let's not just see. In names and all, they will sound fancy, sir. When you go inside, they are not that difficult and all. First time somebody is listening, or so many products are there. Nothing to worry. They are all very simple, very easy. It's just that first time when you learn, you have to absorb too much at once, but it will sink in very easily, sir. Very nicely. There are around 100 questions. You will slowly get comfort on that. You will master it. Don't worry at all. Chapter is lengthy, but a little unfortunate thing is examination, despite all the efforts what we put, despite so many questions we do, of late you can see only 5 marks, 8 marks, like that. Only that much they are asking. The question ka marks weightage is not proportionate to the size of the chapter. But at the same time, this is not a chapter which we take in choice or something like that. It will have consequences in this subject and in other subjects as well. Derivatives and forex are not to be played with. Completely, honestly, sincerely got to learn it. Anyway, now coming into exchange market. So here we are only talking about exchange traded derivatives. So only let's focus on exchange market. Now in exchange market, there are two parts again. The first part we call it as cash segment. The second part, actually we refer it as F&O segment, means futures and options segment, but actually this is derivatives segment. Now what is the definition of derivative? We said it's a contract which derives its value from the value of the underlying. Among that underlying share, index, gold price, commodity prices, all these are there. A share price, gold price, Nifty ka price, all the prices are available here. You enter into a contract here. E contract ka gain or loss is dependent on the prices in the cash segment. So you must understand both the markets at once. Once we understand the basic nuances of futures, options and all, little inside the chapter, you will be putting leg in cash market also, futures market also. Parallelly, you have to think, parallelly questions have to be solved. Okay, so the derivative market is something which cannot exist independently. It is totally dependent on the prices that are quoted in cash segment. So cash segment, clearly if you understand first, then derivative segment, automatically we have a solid base. Without teaching you what is there in cash segment, directly if you go there, it will all sound nice, but later on you get stuck up. Okay, now in cash segment, what happens is, here real buying and selling of shares is done in cash market. If you buy a share, shares are delivered plus cash is paid. If you sell shares, shares are delivered to buyer plus cash is received. This and all will happen on T+1 basis. So trade date plus 1 day, T+1, transaction entered on Monday will be settled on Tuesday. It was T+5 once upon a time, later on they made it T+2, recently they changed up to T+1. There are many countries, including developed nations, they still follow T+2 only. Therefore, while doing questions, if you come across T+2 and all, don't think wrong question and all. So T+2 is what most of the countries also follow today. We recently only we moved on to T+1. Of course, your questions, study mat and all is not updated. According to ICA, it's still T+2 only. It doesn't matter, sir. Nobody will ask you all this, but just knowledge purpose. Next, going further. What else can we say in cash market? Buying shares, okay, shares you have to deliver, cash will be paid. Selling shares, you will sell the shares to the buyer and delivery will be given, cash is received. Then here we have to learn some small strategies in cash market that we will do in a while. So this cash market or cash segment is the base for derivative segment. So the prices that are quoted here are used for determining gain or loss there. In cash market, buyer and seller do not know each other. The exchange acts as a counterparty. Share prices are determined by demand and supply conditions. So if more demand is there, that means more buyers are there. If more buyers are there, obviously price will rise. If more sellers are there, price will fall. So, sir, why more buyers are there? For that, so many reasons are there, sir. Why more buyers are there? Suddenly, why more sellers are there? For that, multiple reasons are there. We'll come across most of them over the course of our syllabus. In share valuation, we have seen something. Did you observe? We have done some questions where share is underpriced, share is overpriced. What does it mean? Share is underpriced means what? It is trading at a price lower than its actual worth. What is the decision? You have to go and buy the share. If this point many people know, what will happen? Everybody tries to buy the share. As people more and more buying happens, what will happen? Demand increases. If demand increases, price will increase. That means what is underpriced share now, because of so many people buying, what will happen? Its price will increase and the price will come to fair value again. Are you getting it, sir? Similarly, overpriced case also. If it is overpriced, people start selling. If people start selling, price will decrease. So this is about cash segment. Now coming to derivative segment, or else derivative segment anyway, we will talk the entire chapter. Cash segment, one important point is that also will finish up. Strategies in cash market. Strategies in cash market. Means what action you should do in order to make a gain. Now, what action you will do basically depends on what you expect for the price to happen in future. So, if price of share is expected to increase, so investor is having a bullish view, which means that the share price is expected to increase. Well, whether it will increase or not, we do not know. Today he believes that price is going to increase. If price is going to increase, whatever price is there today, that is low price or high price? Low price. So what is the general rule? Buy low, sell high. Therefore, the strategy is very simple. It is buy now and sell later. Sir, later means when? Whenever you believe that price is going to increase. Suppose you believe that price is going to increase after 3 months, sell after 3 months. Going to increase after 6 months, sell after 6 months. Sir, going to increase today only, sir, by afternoon. Sell off in the afternoon only. Buy now, morning 9:15, sell off at 2:30, get out. That means it is buy and sell. If they both happen on the same day, then it becomes a intraday trade. That's also simply buy now, sell later is the answer. But if you believe otherwise, like price of share, you believe will fall in future. This is called as you are having a bearish view. So, since you believe that price is going to fall down at a later point, whatever price that is prevailing now, that is high price or low price? High price. So, what do you have to do today? Sell or buy? Sell now. So, in this case, the strategy will be sell now and buy later. Sir, what is the meaning of selling first, buying later? Sir, this is nothing but short sell. We also discussed this while doing forex also and share valuation also. What is short sell? We have discussed. Even though you don't have the share in your hand, you can first sell on the same day, go and enter into a buy transaction. Since sell and buy both are happening on the same day, then I need not give delivery, nor I will take delivery on T+1 day. That automatically get closed up. Okay, then sir, what if I believe that share price will fall down, but not today, but after 3 months? In that case also you can do this using stock lending scheme. We discussed something called stock lending. You borrow share from somebody, sell off in the market now, wait for some time. When you believe the price is going to fall down, at that time go and buy the share and repay the share. In between time, if that share fellow pays any dividend and all, the dividend also you have to compensate. All this we have discussed in the past. That is what is this. Sell now and buy later. So is sell now and buy later. This can be done intraday or under stock lending scheme. Though we have discussed it in the past, just for safe side, for my own safety, once tell me if you have forgotten, no problem, listen now. Stock lending scheme means, guys, I have there is a share in the market whose price today is 500 rupees. I believe that after 4 months, our share ka price will become 350. So today it is 500. After 3 months, it's going to become 350. So today is the high price. I have to sell today. See, I am not talking about selling your existing shares. If I already have share, our share price will fall down, go and sell it off immediately. That is not making gain. That's called as avoiding a loss. That you will not call it a strategy. Strategy means I want speculative profit. I don't have anything in my hand, only idea is there. The idea that I want money. So my idea is share price is gonna fall after 3 months. If this idea proves right, I should be able to make money. So what strategy works? This sell now, buy later strategy works. Now if I have to sell today, first of all I should have share. So for that, what you have to do? You have to borrow shares from lender through broker. After borrowing, sell the shares immediately. Sir, the moment you sold the shares, you have already received money, but in your mind one obligation also exists now. What is that obligation? You have to buy the share in the market and repay the shares to the original lender of the shares. So, at future date, buy the share in the market and deliver it to the lender. Since you believe that by this date share price would have fallen down, you will be buying the share at a cheaper price. Today you sold at 500 and after 3 months you are buying the share at 350. So effectively, if you observe, you sold something at 500 and now you are buying the same thing at 350, which means you are making a gain of 150. That fellow who gave shares to you for the purpose of your trading transaction, that fellow you have to pay something called as a lending charge. Normally, if you borrow money, we pay interest. Here, instead of money, I am borrowing his equally liquid asset called as share. So for that, he expects something, that lending charges have to pay. That's nothing but interest calculation, nothing else. So also pay lending charges and reimburse any dividend declared on shares during borrowing period. So what is your gain or loss in this? Your gain or loss in this is your original sell price minus your buy price minus your lending charges minus any dividend minus brokerage. The broker who facilitated this transaction, of course, you did a sale transaction, you did a buy transaction, you have to pay brokerage. So this will be your ultimate gain or loss. In cash market, these two strategies we should be very clearly understanding, sir. Without these derivatives, learning is incomplete. There are some questions which you can't even solve. You don't even understand without knowing all these points. So till here clear? Easy only. So what did we learn? Only two strategies. One is sell now, buy later. That is when share price is expected to rise, buy now, sell later. When share price is expected to fall, sell now, buy later. If this buy and sell both are happening on the same day, it's an intraday trade. Otherwise, it is a long-term transaction. Next. Now, coming to the terms now. Long position and short position. In cash market we are talking. So somebody is writing, well and fine, otherwise if you can't write, just listen. All these are there in the book anyway. But if you write, it is better, because these things are not for general understanding. You have to apply. So it's not like watching a YouTube channel or a news channel and casually remembering things. It will not work that way. It's a serious thing. Better you write. Okay. Next, coming to what is the meaning of long position? Generally, sir, the term long, not only in cash market, later on when we learn futures market or when we go into options market, the term long is associated with the word buy, and the term short is associated with the transaction of sell. So long basically means buying, short basically means selling. That's a basic meaning, sir. But these terms long position, short positions, the actual meanings of this will vary depending on in which market you are standing. When you are in cash market, the word long position, short position will mean something. When you stand in futures market, long position, short position ka meaning is different. Options market, completely different. You should know everything without getting confused. But as such, what is common is the word long means buy, short means sell. Sir, then why will you get confused? We will see. Why you will get confused? Multiple reasons are there, just like share price. Anyway, example number 1. So Mr. A purchased 1,000 ITC company shares. I don't know how much it is, 400 rupees. 400 rupees per share. Actual transaction is this fellow actually bought. Okay. Now what is how we will say this is, means how we can also express this is, Mr. A is having a long position in ITC shares. To be more specific, in cash market. We are not at all into derivatives yet. We are still discussing cash market. This only, you can even condense it and say Mr. A is long on ITC shares. All these things mean the same thing. First one directly telling you that this fellow purchased and holding shares. Second and third term are expressing language, sir. That's all. They all mean the same thing. So in cash market, long position ka term means buying the shares and holding them. So this is the meaning of the term long position in cash market. Now coming to next example. Mr. Y sold $500 Infosys shares at rupees 1,800 each by borrowing the shares. What this fellow sold is not his shares. His shares, if he sells off, no sir, I will not call it a short position. If you borrow shares from somebody and you sell them off, that is called as short position. Now how can we say this? We can express this like Mr. Y has a short position in cash market. If I say this, it's not sufficient. Cash market la short position means this fellow borrowed some shares and sold off that shares, and now he has an obligation to buy that shares. Which shares? On Infosys shares. They all mean the same thing. So short position ka term means selling the shares. Not selling your own shares, selling the shares with a obligation to buy. This kind of sell shares where again you are obligated to buy, that is called a short position. Obviously your stock lending scheme, whatever sell you make, that is definitely a short position, there is no doubt in that. But intraday morning you sold, but before the close of the day you have to buy and deliver, that is also a short position because you are obligated to buy. So it's not selling your own asset, you sold something which you are supposed to again buy and make it good. Now, watch this. Mr. X purchased 1000 Ultratech cement shares and sold them after 3 months. In this, the first transaction, whatever is there, he buying 1000 shares. E part is definitely long position. This is called as a long position. E part, whatever is there, this is not short position. This is not a short position. This is called as your squaring up transaction. Yeah. Yes, sir. It is covering up or squaring up transaction. Why that is not a short position even though sell is there? You sold off your own shares. You don't have an obligation to buy it back again. If you have an obligation to buy and deliver it to somebody, then only we should call it as short position. If you sell off your own shares, you should not say, I am having short position. You don't have any position first of all. Whatever shares you have, that only you sold off. No sir, no. How can you have any position? No sir, if you use the language wrongly, people will laugh at you. Sir, questions here and there, they use this terminology. So, definitely required. Fine, sir. So, you understand what is long, what is short position. Now, tell me, sir. Once again, strategies already discussed, but again, if price of share, first case, expected to increase in future, I believe that price will increase in future. If price is expected to increase, the strategy what you have to do is buy now, sell later. A buy now, sell later only we call it as take a long position. So instead of telling you buy now, sell later, I can simply use take a long position. Now, take a long position now means what? Go and buy the share. And share price increase, at that time automatically you have to go and sell. If share price is expected to fall down, the strategy should be sell now, buy later. Sell now, buy later only we call it as short position. Take short position in shares today. Okay, look at this. Computing gain or loss in cash market. If basic terminology is clear, all this gain and loss and all will be very easy. You can take any example and think and get. So, existing position, market price of share increased, market price of share decreased. Sir, focus on understanding. Writing, next option, next priority. First understand. What is the meaning of long position? Buy, no. Sir, buy any general word, sir. When did I told you? 20 minutes back I wrote long means buy. If you still tell me buy, what is the point of discussing this? Long means you already bought shares and you are holding them. Okay, and that means you purchase shares at a particular price and you are holding them. Now share price has increased, good or bad? No, sell, of course, sell anyway we will do later on, but it's good or bad for you? You purchase shares at a particular price, price sold up, price increased, good or bad? Good. So this is definitely a case of a gain for us. Suppose the share price has fallen down after you bought the shares. You bought the share at 1000 rupees, share price is now trading at 820. Loss will feel good or bad? Bad. You might not have sold it, but still there is a loss if you suffer it. If you sell it, definitely you'll suffer a loss. So this is a scenario of loss. Similarly, for short position. Short position means I borrowed shares from somebody and I sold off the shares. Or I sold off the shares with the obligation to buy it back later on. When I went to buy, market price has increased. Good or bad? Bad. This is definitely a loss for us. And when I went to buy the shares, share price has fallen down. Definitely I'm happy. This is gain. Sir, this and this, everything is same only, sir. Different perspectives. I'm showing you the same thing so that you'll understand it clearly. Questions won't be straightforward. Questions will be twisted in all angles possible. So from any angle, you should be able to see the same reality. If a particular question, if you find gain, same thing if I ask in a different way, you should not say loss. Okay. E kind of tables, sir, people understand one gain, one loss, rest opposite they'll fill up. Sir, this is not fill in the blank story. You are not playing tic-tac-toe, okay? So you just understand the logic behind each of them. When I say long position, immediately in your mind, I already purchased shares at a particular price. Price fallen down, obviously loss. I borrowed shares from somebody and sold off. Now I have an obligation to buy the share. Short position means what comes into everybody's mind is sell. But what should ideally come is obligation to buy should come. That will determine this very easily. I sold the shares, correct. They are not my own shares. I have an obligation to buy and deliver the shares to somebody now. So when I went to buy, share price, if it's increasing, that is bad. If it is decreasing, that is good for me. I'll be clear here. Next. This only means this strategy, gain or loss, all this. Further, if I simplify, it is like this. In rising market, long positions give gain. And in falling market, short positions will gain. So the strategy what we have discussed, the gain or loss dabba what we wrote, they both can be summarized into one small summary like this. Rising market la long positions will give gain, falling market la short positions will give you gain. E line, if you remember, strategy also you can draw, gain or loss also you can identify. If I tell you share price is expected to fall, which position will you take? Obviously, if a share price is expected to fall, you should go and take short position. Share price is expected to rise, long position. I took long position, but share price risen. Gain or loss? Gain. I took long position, but share price fallen down. Loss. Falling market la short position only will give gain, which means automatically long positions will lose. So this one particular summary will help you to reconcile all this story. Are we clear till here? We are still talking about cash market. Now come back. So we have started by discussing the meaning of derivative. We told you that derivative contracts, if somebody wants to enter, they can enter into a derivative product in exchange market or over the counter. Exchange market is online dating, sir. Over the counter, direct meeting at a party. Okay, so over the counter, the parties know each other. The terms and conditions are customized. Exchange market is more or less like a blind date. But even though you don't know, okay, fine. Going further will be very bad. Leave it. Leave it. My bad. I'm very sorry. Next, exchange market. Sir, you people encourage me to do and tell all the stupid things, and I forget that I'm in front of a camera. Okay, you don't know anything, sir. Okay, fine. Coming to exchange market, sir, related to over-the-counter market, over-the-counter contracts, we have already discussed the forward contract in Forex chapter. Remaining contracts we will cover in IRRM chapter. Now, in this, we are going to cover only exchange market, exchange traded derivatives. So, if you have to understand that, first of all, exchange market, what is there, we must know. Exchange market, there are only two segments, sir. One is cash, one is derivative segment. A cash segment is a real market, original market. This is where the proper trading will happen of shares and all the securities. And here real buying, real selling will happen. What is the meaning of this real buying, real selling? You will understand more clearly when we go into derivatives. So when you buy shares, you have to obtain delivery of the shares by giving full money. Same is the case with selling shares. If you sell shares, you have to give delivery of the shares to the opposite party and you will receive money. As on today, it is T+1 basis. Next, the buyer and seller do not know each other. The exchange will act as a counterparty. Share prices are determined by demand and supply conditions. Now, in cash market only, strategies. If I believe that share price is going to rise later, then today I have to buy the share. Later on, I have to sell the share. This only we call it as take a long position today. If I believe that share price will fall at a future date, I should sell now and buy later. Selling now and buying later only we call it as taking a short position today. That's all, sir. Up to here we have discussed. And regarding gains and losses, we summarize like in a rising market, long positions will give you gain. In a falling market, short positions will give you gain. Clear? You don't have one question also directly on cash market. But there are questions on options and futures where you have to do strategies in cash market. Then only that entire concept or arbitrage or speculation is possible. So you have to know all this, but I cannot show you an immediate question on this. It takes some time to see applications on cash market strategies. All these are there, but not immediately. Chalo, sir. Okay, now that cash market stories are done, let's move on to the first part of derivatives, which is options contract. So in derivative market, which are exchange traded, there are only two contracts. One is options, one is futures. In terms of questions on options and futures, they are independent, sir. The questions on options and futures are totally different questions. So you can start the chapter with either options or futures. There is no interconnectivity as such. But some of the basic concepts will overlap, but the instruments are completely different. We can start with any instrument and later on proceed to the other instrument. But options being conceptually little deeper than futures, and the questions are also, questions are easy, but the concept part is slightly complicated and deep. So despite the difficulty, it's better we start with options. Futures, on the other hand, concept wise extremely simple, but almost some 50 questions are there only on application. How to use futures for hedging, speculation, arbitrage. So that is going to become very deep. So first we'll finish off options. Why options first is, initially our little high energy level, since you are still knowing what is derivative, high focus level, so we get rid of options. And once options is over, by the time you feel little tired, at that time futures anyway will be easy, that will naturally take its own course. So you want the other way, huh? So sorry. Okay, listen. Yes, sir. Coming to options contract. In an option contract, there are two parties. Holder and writer. So there are two parties, sir. Holder of the option, writer of the option. This holder has a right. Now what right he has, we will see later on. He has a right. This fellow writer, he has a obligation. Right. Okay. This holder has a right and writer will have a obligation. Now what right he has, what obligation he has, that we do not know as of now. But understand, when two parties enter into a contract, the person who is having a right, don't you think that he is having a little more advantage compared to the other party who is accepting an obligation? Right? One party is having a right, the other party is having a obligation. Why will he accept an obligation like that? When we both enter into a contract, we both should be on the same footing, isn't it, sir? If I have a right, you should also have a right. If I have an obligation, you should also have an obligation to do something. But if it is like I have a right, the other party is only having an obligation, a contract, don't you think it's slightly one-sided now? Right? It is working only in the favor of holder. And that fellow writer, why will he even enter into a contract? So what actually happens is, in this option contract, this holder pays upfront consideration, which we call it as premium to writer. So why that writer is having obligation is he accepted money from the holder. I paid money and I purchased the right from you. You took money and sold the right to me, or you accepted an obligation on yourself. If there is no this money transaction on day one, I paid money to you, sir. Since I paid money to you, I have a right and you have a obligation. So this holder purchased a right. This writer sold a right. That's why holder of the option is also called as buyer of option, and writer of option is called as seller of option. Sir, this will definitely confuse you later on. So this concept, some people learn it as a buyer of option, seller of option. Most of the people learn it as holder writer. But as we go further, after some 10 minutes, if you look back at this, these things may still confuse you. That's why remember now only clearly. Why are we calling him as a buyer? Why are we calling him as a seller? What did he buy? Share. Share he did not buy, share he did not sell. Right. A right he purchased, an option he purchased. From whom? From the other party. So that other party took money and he accepted an obligation, means he gave a right to me. That since he sold his right to me, he is called as seller of the option. That fellow who bought the option, he is called as a buyer or holder of the option. Are we clear till here? And just to tell you, now that you have listened so much, this holder position is also always called as long position. and writer position is always called as short position. Once again, sir, what did he sell? Share? Right. Option paper he sold. Option, there are two parties. Option means a choice. Who is having choice? Not both. Only one fellow has a choice. The person who has a right, he has a right means he has an option to exercise or lapse it. The other party does not have a choice. Whatever he does, he has to only follow. He simply has to say, yes, boss. This fellow has a right to decide. But how did he get that right? Because of this premium, upfront premium. This is the reason for his right and that fellow's obligation. Till clear? Now, next point. What are the type of options we have? There are two types, sir. One is a call option. The other one is called as a put option. So we have to learn call option, put option separately, sir. In call option, the holder will have some right, writer will have one obligation. Similarly, in put option, again, holder will have a right, writer will have an obligation. But what right he has, what obligation the other fellow has will change depending on whether we are talking about a call or a put option. But let it be call, let it be put, holder will always have the right and writer will always have the obligation. Let it be any option. Let it be any option. Sir, what right he has, what right this fellow has, what obligation the opposite fellow has, that depends on whether we are talking about call or put. So now we will see one by one, sir. First we will go through call option. So in a call option, the holder has right to buy the underlying asset at predetermined price, which is called as strike price or exercise price. On a future date. So the moment we use the word call option will give the holder a right to buy the underlying asset at a predetermined exercise price on a future date. Sir, this is like forward contract only. In forward contract also we enter into a contract with the bank to buy some dollars on a future date at a price decided today, isn't it? But what's the difference between forward and option is, in forward, when you enter into a contract to buy $10,000 at 85 rupees, after 3 months you have to buy the dollar irrespective of spot price. So spot market rate is 80 only. I unnecessarily enter into a contract at 85 with you. I will not buy, I will buy in the open market. Not possible. Forward contractually you have to execute it. But this is option. This is not agreement to buy, right to buy. If I want to buy, I will buy, otherwise I will not buy. So if it is convenient to me, I will exercise this option. Not, I will lapse it, I will ignore it. So there is a difference between agreement to buy and right to buy. Forward futures are agreements to buy. This is right to buy, call option for the holder. Since holder is having right to buy, writer will have what? Obligation to buy, obligation to sell. Whether that fellow will exercise the option or not in future, the time only will tell. But if he exercises, then definitely this fellow has a obligation to sell. Sir, holder choose not to exercise the option. If holder chooses not to exercise the option, you should not say I will go and exercise. You don't have that right. Writer will not have a right. He has only a obligation. If the other fellow says I am exercising, you have a obligation to sell. Otherwise you can't sell. So here in a call option, let's say the underlying asset is TCS share. Strike price is 4,000. Maturity is 3 months. So there are two parties. He is Mr. H. This fellow Mr. W. He is holder, that fellow is writer. Obviously, he became a holder only by paying some consideration to the writer. That consideration only is called as option premium, upfront option premium. So, because this fellow is a holder, what right he has? He has a right to buy. Who is underlying asset here? TCS share. So, TCS share at 3 months for rupees 4,000. In reality, sir, there will be a lot size also. What is there? You can add one lot here. 2,000 shares. The lot size will not unnecessarily deviate your main thing, but anyway, just for the sake of it, I'm adding 1,000 shares. So if H is having a right to buy, this fellow will have an obligation to sell. E capital X is called as exercise price or strike price. Since it's exercise price, usually we denote it with X. Some people also denote it with capital K. That is also okay. So tell me whether Mr. H will exercise this option or not. It's based on what? It's based on the price of TCS share at 3 months time. Okay. No. At 3 months. Case 1. Cash market price of TCS share 4,800. Case 2. Cash market price of TCS share is 3,400. Tell me guys, in the first case, what will the holder do? Sorry, always see in the question you may be holder, you may be writer. Okay, in the question, some questions are holder, some questions are writer. But always thinking should be done only from holder point of view. Why? It is holder who will decide whether the option will be exercised or lapsed. So, action of holder. Tell me sir, holder means I have a right to buy at 4,000. Under call option I can buy the share at 4,000 rupees. Marketly if I want to buy, I have to buy it 4,800. Marketly if I buy 4,800, under call option I can buy it 4,000. Will I exercise or lapse? will definitely exercise the call. Exercise the call option. Why are you exercising the call option? Because the market price or the spot price is greater than the exercise price. Second case later on we'll fill up. Okay, because you exercised, there is some benefit to you. What is that benefit? 800 rupees. How do you know 800 rupees? 4,800 when the market price is there. I am able to buy that share only at 4,000. So, benefit to holder on exercise. This is also called as payoff. Payoff is a benefit, sir. So call option, how much is the payoff? Payoff is equal to, in a call option, spot price minus exercise price or market price minus exercise. Spot price, market price, they both are same. So 4,800 ka share, I am able to buy only at 4,000. So the benefit I am getting is 800 rupees. Now, settlement. Possibility 1 is physical delivery. Meaning, the parties to the contract will execute the contract as entered. What was the original contract? H has a right to buy and he is actually buying, and therefore what should W do? W should sell the share. So sell TCS share to him, and this fellow will pay you an amount of rupees 4,000 rupees per share. Why is the other fellow sad? Simply, not simply. Market share price is how much? 4,800. Still he is supposed to sell the share only at 4,000. That's the reason he is sad. He is selling the share at a lower price. Sir, then why did he enter, sir? He hardly believed that share price will rise. That fellow believed that share price will fall. That's why he entered, but ultimately share price has increased. This is called as a physical delivery. Now, sir, till before 3 years, up to before 3 years, since in India derivative segment is started, physical delivery was never there. Only net cash settlement you have to do. Net cash settlement ka meaning is, no, there is no share, nothing. Simply, you have to settle the gain or loss in cash. Possibility 2, net cash settlement, or simply net settlement in cash. So there are two parties, your holder, writer. There is no share, nothing. W has to pay to Mr. H the amount of payoff in cash. So whatever payoff amount is there, that amount that fellow has to pay in cash. Sir, what about share? No share, no delivery, only net cash settlement. Sir, then why TCS share you have selected? We both betted on TCS share. I told 4,000, market price of the share after 3 months will cross 4,000. That fellow told that much scene is not there. Bet. And price actually went beyond 4,000. It is 4,800. I won the bet. So he is paying me an amount of 800 rupees. Clear, sir? This is pure net cash settlement. But what happened is 3 years back, there is a small update in the stock market in India. What they have told is, if you enter into any futures and options contract and hold that options contract till the maturity date, last day, you have to compulsorily obtain physical delivery. Net cash settlement is not possible. You have to obtain physical delivery on the last day. That means, sir, is net cash settlement possible now or not? If the underlying asset is share, today it is not possible, sir. If you are standing with this options contract in your hand till the last day, option is exercisable. Definitely you have to obtain physical delivery. But most of the many questions are, because these questions in India are coming from so many years in the exams, and all these years it was only net cash settlement. Many questions, even ICA answers also, if you see, the final result will be in net cash settlement only. But today things have changed. Questions also will change. Slowly they will change. Okay. But in reality, today you have to obtain physical delivery. There are some more issues, like if you want to obtain physical delivery in options or futures, you have to give intimation of that on the last maturity date. Some margin amounts you have to keep and all. You have to show that you are capable of buying the shares, that money and all, you have to keep it ready. These are all practical stuff. That's not relevant from an examination point of view. So in the exam, what should we do? Should we take delivery or should we do net cash settlement? Sir, listen. Question will clearly tell you whether you physical delivery you are taking or net cash settlement you will do. 99% they will tell you. And in those questions where they don't tell you, you do any one, it will be the same effect. How it will be the same effect, I will tell you. Watch first scenario. I have a right to buy the share at 4,000. Market low price is 4,800. Therefore, I exercised the option. I am not at all interested in share. I want only 800 rupees. So, it's not your choice. No, this is not choice 1, choice 2. There is no choice, sir. If you stand in the options market till the last day and option is exercisable, compulsorily you have to obtain a physical delivery. There is no option. But I don't want. You don't want, first what you do is buy the share by paying 4,000. Now share is in your hand, sell off the share in the market. At what rate? 4,800 today's spot price. That means effectively what happened? You sold at 4,800. What you bought at 4,000. Effectively your pocket how much is there? 800 rupees. Other if you do net cash settlement, then also 800 only will be there. Otherwise, let us say there is a particular transaction which has to be closed only by way of net cash settlement. But I want delivery. Let's say delivery is not permitted. Hypothetically imagining that. Delivery is not permitted, but I want to buy TCS share at any cost. No problem. Anyway, you are prepared to pay how much? 4,000. That fellow is giving you how much now? 800. 4,000 already pocket lay there. Now received 800. Total 4,800. Go buy share in the open market at 4,800. That means if I want, I can convert this into net cash settlement effectively. Though I am taking physical delivery, I can also sell the share and obtain 4,800. Overall, I will be having only 800 rupees cash. Means, or if I want to continue holding the share, that is also possible. I simply don't do anything, just hold it. Or here, even though you receive cash, if you really want to buy the share, you should be prepared with 4,000 rupees already. Now that fellow gave you how much? 800. With this total 4,800, spend off this 4,800 and buy off a share. It doesn't matter how you settle ultimately. If you want cash, I can convert physical delivery into cash. If you want share, cash I can convert into physical shares. That is not at all a problem. Okay. But in reality, sir, today, in options on shares, physical delivery is mandatory if option is held till maturity. This is today's position in India, sir. But 99% of the times people enter into options not for delivery, purely for betting. That fellow is anyway not interested in taking delivery. If he really wants to buy the share, he could have bought the share directly in cash market only. I go into derivative market purely for betting. So what they do is, on the last day before closing the market, that fellow will exit out of call option. How to exit we will discuss later on. So physical delivery people generally don't take. in reality, there are so many other issues, sir. Margins and all will be there. They'll ask you to deposit 100% of the money. Otherwise, they'll ask you to square up the contract and get out of call option just 2 days before the maturity date. All these are practical points. Let's not go into that. It's not relevant at all for you. Sure. Up to here, clarity is there. Now let's move on to the other part. Again, come back. I have a right to buy the share at 4,000, but market price is 3,400. Where will I buy the share? In the market, under the call option? In the market, not under the call option. Therefore, what will I do here? I will lapse the call option. So, when market price is lower than the strike price, it is better for me to buy the share in the market rather than buying it under call option. Next, now that you lapsed the call option, how much is the benefit holder got on the date of maturity? No benefit. Why no benefit? Option got lapsed. Settlement. What will happen on settlement? No settlement. Tell me, sir, why is writer smiling in the second scenario? He need not pay anything. He need not suffer loss. First day, remember, holder paid money to writer. That money nicely will be in the pocket of writer only. He need not pay back anything. Whatever amount is received, that is totally gain for him. Why is this fellow sad? He paid money, a money he could not recover because option did not get exercised. Are you getting it, sir? It is an option, it is a choice, true, but the choice has a cost. What is the cost? Premium. Sir, you told it's a betting contract, but one side bet. If I win, you pay me money. If I lose, I won't pay you money. So cheating, no sir, where cheating? I already paid money for that also on day one. If it was a contract, say equal size, equally poised betting, why will I pay money to you? This is one side bet. If one side bet I purchased, I entered into contract by first day, I gave you money. I said that if I win, you pay me my money or whatever gain I get. But if I lose, I won't pay you money. This is cheating, why will I enter? You will enter because I will pay you money on day one. Worst case from my point of view, what will happen? The option is lapsed and therefore whatever money I gave, that is loss for me. That's a maximum loss I will suffer. And that's the best possible thing that can ever happen to you. From a writer point of view, it's the best possible thing that can happen. Option gets lapsed like this. If option gets lapsed, what happens? Whatever premium that fellow received, that nicely stays in his pocket only. There's a maximum gain writer can get. So from this example only, we can also identify maximum loss to the holder and maximum gain to the writer, which is nothing but premium amount. So till the clarity is there. Now, sir, this is all about call option, sir. Now, note point. If underlying asset is currency or commodity or index, then physical delivery is not allowed or possible on maturity date. Only net cash settlement is done. Currency, same call option, sir. Instead of TCS share, if I say $1,000, I have a right to buy $1,000. at $1 is equal to 80. Market spot price 85. When market dollar is 85, I have a right to buy at 80. Will I exercise or not? I will exercise. Now that I exercise, I want to buy dollar by paying you 80 rupees only. But currency ka delivery is not permitted. Commodity ka delivery, gold, silver, soya bean delivery not permitted. Index not possible. Those two are possible, not permitted. Nifty, how can you deliver, sir? That is shadow. That's an indicator. How can anybody buy and sell indicator? That's only for calculation purposes. Delivery not possible there. So, in three cases, sir, I am a holder, sir, I am winning, sir. You win, you will take cash for that. Real asset will not come. Till recently, share also is in this category only. They changed it recently only. Physical delivery. Even though it was only net cash settlement, at that time also, we used to discuss physical delivery. Why we used to discuss physical delivery is, here, see sir, we are talking about call options and put options which are traded in stock exchange. Sir, here, do you think Mr. H and Mr. W, they know each other? No, the exchange traded call option. But what if you and me enter into a call option? Possible. You know my face, I know who you are, and then we both enter into a contract. One-sided betting contract, that is also a call option. Now whether we will close by physical delivery, whether we will do net cash settlement, the exchange will decide, we will decide. We will decide. So you should know that both the possibilities exist. What they will do, that is party's wish. If it is a transactional stock exchange, like how we are talking, commodity key, in reality delivery is possible, but market will not permit it. Exchange is not permitting it, therefore we are doing net cash settlement. Commodity somebody can deliver, no. Currency somebody can deliver, no, but it's not permitted. Nifty, not possible only. Nifty is not an asset to be bought and sold. So that's the reason, sir. But you should know both the possibilities. Depending on the case, we will see whether we will do physical delivery or net cash settlement. So till here clarity is there. So summary of call option is, what is summary of call option? When we say call option, what should immediately come into your mind is, holder has a right to buy, and writer has a obligation to sell. Okay guys, let's move on to next option, which is put option. In a put option also, here also two parties are there, holder, writer. Put option ka holder will have a right to sell the underlying asset in future at predetermined exercise or strike price. He still has right only, but the nature of right is changing. Call option was right to buy, put option is right to sell. Writer will have a obligation to buy underlying asset in future at exercise price, also called as strike price, if holder exercises the option. If I have a right to sell, the other fellow will have an obligation to buy. Next. Example, take a put option. Underlying asset, Reliance Industries shares, lot size 1000 numbers, strike price 1200, maturity 3 months. This fellow is Mr. H. Here Mr. W. So this fellow has a right to sell Reliance Industries Limited shares at 3 months for rupees 1200. If I have a right to sell, this boy has an obligation to buy. Again, same thing, whether this option will be exercised or lapsed depends on what is the actual price of Reliance share at 3 months time. This is price in cash market. In cash market, this is the price. Based on that price, you have to decide what will happen now. So first one, action of the holder. Always holder point of view, the option ka future will be decided. Holder has a right to sell the share at 1200. Market price is 1500. Will I sell at 1200 or 1500? 1500. So put option will be lapsed. So put is lapsed. Why? Because the spot price in the market is higher than the exercise price. I can as well sell in the market instead of selling it under put option. Then payoff to holder. Payoff input option. Payoff input option is nothing but benefit to holder or loss to writer. Anyway, 0. Why is it 0? Put is lapsed. Settlement, there is no settlement. Option is lapsed. Nothing will happen. But if you go to the other side case 2, market share price is 900. I have a right to sell the share at 1200 under the put option. I'll exercise or not? Definitely put is exercised. So here put is exercised by the holder. Why is exercising? Because market price is lower, option price is higher, strike price is higher. Market share is 900 only, but I am able to sell it at 1200. So I am selling at 300 rupees higher. That's a benefit for me. So put option payoff is equal to X minus spot price or X minus market price. This will basically tell you gross benefit to the holder and gross loss to the writer. Possibility 1, physical delivery. So physical delivery means whatever contract you have entered, as it is you execute. I have a right to sell and I am exercising the option, which means you will sell share. Sell RIL share. And for every share I sell, that fellow pays me an amount of 1200. That means he is buying shares from me at 1200 even though market share is available at 900. This share what he is buying from me, if he sells in the market immediately, he will get only 900. But he paid to me 1200. That's why he is sad, obviously. possibility 2. If it is net cash settlement, no share, nothing, directly settle the payoff in cash. You observe that on the maturity date, when the option is exercised, it's always the writer who prima facie suffers a loss. Overall, whether he is gaining or losing, that we can tell only after comparing this payoff with the original premium. See, sir, very clearly in 300 rupees, holder is making a gain. But what if the premium paid is 350? Today I am gaining by 300, but to get this option only I paid 350, which means overall I am still suffering a loss. Sir, then why are you smiling shameless? Sir, that is my face, sir, I can't help. Not like that, sir. At 350 you already paid off. Whether, see, at 350, no matter what you do, at 350 will not come back. So if option is getting exercised, at least something you are recovering out of that. That's why this fellow is smiling. So that is sunk cost, sir. Whatever is already spent is irrelevant for decision making. So premium we will never bring into the picture when we are deciding whether to exercise or lapse. You should not say overall anyway last. No, sir, let me not exercise only. Sir, first of all, listen, these are all exchange traded derivatives. Nobody will ask you, will you exercise or lapse? Tell me fast. No, sir. If the market price is convenient to you, option automatically gets exercised. You need not say and shout exercise, lapse. No, the examiner, sir, all this exchange market, sir, once you take an option call or put and it is in your favor on the maturity date, you need not go and shout there exercise. That automatically will take care of it. Option automatically gets exercised. Okay, your choice, nobody will ask, sir, a system has automated so many things, your stupid choice, on what basis will you decide, doesn't it? No. So it picks up the price from the cash market, it compares, if it's favorable to you, option automatically will be exercised. They will give you a call asking if you want a delivery, then deposit full money 1 or 2 days before. Or you want to keep delivery of shares in your demat account, that share should be there. That is not there, sir, I don't have money, sir. Fine, cash settlement, close the position. So all this practically relevant. Okay. Tell me this. Again, same story, sir. Net cash settlement is done for whom? Currency, commodity, index and interest rate options. These are all cannot be delivered or not permitted to be delivered. Therefore, you have to do only net settlement in cash. If it is a share based options, let it be call or put, compulsorily physical delivery has to be given. In any questions, if they have done cash settlement, don't find fault with them. That's okay from an examination point of view. Examination, nobody will test whether you are doing physical delivery or net cash settlement. That's not at all a criteria, because this is a very recent amendment. None of the books in the market have been amended till now. Okay. Now coming further. Can you summarize this? When spot price is greater than X and spot price is lower than X, what will happen to call option? What will happen to put option? You can write this later on. First you can summarize this, because before this, one more small point I have to cover. But anyway, first you can answer this. Yeah, exercise or lapse? Which one? Call option exercised when spot price is greater than the exercise price. So here call option is exercised. In any other case, call option will be lapsed. Put, when will it be exercised? Spot price less than exercise price. So here it is exercised and here it is lapsed. Now how you will remember this easily is, look at this. Call option means, what should come into your mind is right to buy at exercise price, and put option is a right to sell at exercise. Sir, I am writer, sir. You can be anybody, but exercise or lapse option, who will take? Holder. So holder point of view, you should analyze this. Are you getting it, sir? Now observe this closely. I have a right to buy at X. Don't forget about all this. Okay, wait. Your thinking should be like this. Right to buy at strike price. Market ka price is higher than strike price. So where it is convenient for me? See, since I am a buyer of share, I will buy wherever it is lower, wherever it is cheap. Where is it cheaper? Optional it is cheaper. No, so you will go and exercise the option here. I want to buy share, I have a right to buy the share at strike price. But I saw market price is lower than that. So I can buy the share in the market only. So call option will I buy? I will lapse. I will lapse. Therefore lapse. Put option. I have a right to sell at strike price. But market low price is even better than strike price. I am a seller of share. I can sell at strike price under put option. Outside I can sell at a higher price. Where will you sell? Put option outside. Outside. So here you are going to lapse your put option. And similarly, I have a right to sell the share at strike price. Market low price is lower, so strike price is higher. So selling at higher price only I want, no. So you have to go and exercise it. You should understand the logic clearly and ultimately remember also. Every time you should not think what is going to happen. That slowly you should remember. That will come to you. Nothing to worry. Next. Tell me positions in a call option, input option, or you may be more comfortable like this. Okay, fine. Get comfortable like this only. Okay, tell me, sir. Call option holder, what does he have? He has a right to buy. I am not specifically writing right to buy share because later on it can be commodity, currency, index and all. So that's just right to buy. Put option holder will have a right to sell. Call option writer, obligation to sell, and this is obligation to buy. Now I will ask you one question without getting confused. Think slowly and answer. Share price is expected to increase. There is a share whose price is going to increase in future. In cash market, I am not talking about options. Cash market, what strategy will you do? Share price is expected to increase. What strategy? Buy now, sell later. That is nothing but long position only. Clear ma? Right. Here, under options market, which strategy will you do? I did not teach you this specifically, but you can watch and answer. So, which position will give you gain when share price increases in future? Call option. Why? If market price increases and it increases beyond your strike price, call option will be exercised. So holder of call option will make a gain only when option gets exercised. Clear? So when share price is expected to increase, the position you should take is call option ka holder. Of course, you can also take put option ka writer also. Put option ka writer, what does he believe? Slowly think. So there is no harm, no hurry, peacefully think. Call option holder, sir, holder always wants option to be exercised or lapsed. Any holder, he wants option to be exercised. Why like that? Because I paid money, na. Option is not free. I paid premium. If that premium has to be recovered, option has to exercised, and I should receive some benefit out of the option. Benefit I will get only when the option is exercised. Now come back and tell me. Let's go to call option example. This fellow Mr. H, he paid something to Mr. W and he purchased a right to buy TCS share at 4,000 rupees. He wants this call option to be exercised or lapsed ultimately. Whether actually what will happen, that is not in his control, but he wants the option to get exercised. And when will the option get exercised? When will the option get exercised? When market share price is beyond 4,000, then only it will increase. Correct no sir? Then only the call option will be exercised. So can I tell from that this fellow believes that market price of the share will increase? Is this not his feeling? Yes. With this feeling only, he paid money and he entered into a call option. Ultimately, whether share price will really increase or not, that we do not know. That's a chance. Suppose share price became 4,800. What will holder do? He will exercise. How much benefit is he getting? 800. Already some premium I paid. 800 rupees minus that premium is my gain or loss. Are you getting it, sir? Now, if holder is exercising the option and is happy, then writer should be sad. Then why did writer enter into the option contract first of all? He has a different feeling altogether. Sir, he is not somebody who believed that share price will increase. Tell me, sir, if you are the writer of an option, you want option to be exercised or lapsed? Writer always want option to get lapsed. Now, when will a call option gets lapsed? When marketless share is available cheaper than the exercise price, the holder will prefer to buy the share in the open market rather than buying it under call option. Therefore, call option will be lapsed. So, what is this fellow's feeling based on that? Tell me. He believes that market price of the share is going to fall, and it's going to fall below the exercise price, to be honest. If the share price falls below the exercise price, definitely option will get lapsed. That means holder wants case 1 to happen, writer wants case 2 to happen. Ultimately both will not happen, only one will happen. But at the time of entry, this fellow has a bullish view, this guy has a bearish view. Sir, if I also believe share price will rise, you also believe share price will rise, we both become holder writer. Huh? No, we have to find somebody else now to enter into our contract. We both will not enter into any contract here. Are you getting it, sir? If two parties are entering into the contract, their feelings are different. They have opposite expected movements on the share price. Then only they entered into a holder and writer position. So tell me guys, if you know that share price is going to increase, call option holder is one route of taking a position. Because if share price is going to increase and you are a call option holder, it is likely that call option will be exercised and you will make a gain out of that. Similarly, come here. This is put option. In our put option story, the underlying asset was Reliance Industries share, strike price was 1200 and this fellow has a right to sell at 1200. When will he exercise this option? Right to sell when market price is lower, then only he will exercise the put option. And holder always wants to exercise the option only. Tell me, sir, from this, what is this fellow's feeling? Market price of share will fall. If he does not have that feeling, he will not pay money and become a holder of a put option. Tell me now, writer, what feeling does he has? He feels that option will be lapsed in future. When will put option be lapsed? When market price is higher, then the holder feels okay, we can sell the share outside, that is better for us than put option. Therefore, put will be lapsed and therefore he believes that market price of the share will increase. So people with different expectations, if they enter into contract, the positions will occur, sir. Ultimately, both the expectations will not come true. No, market price cannot increase and decrease. Both cannot happen. Either case 1 or case 2. So from this we can talk about expectations or sentiments. At time of entering into option contract. Call option, put option, holder, writer. Holder of call option will have what feeling? Market price will increase or fall up. So he believes that market price of share, or simply read market price, increases. Holder of a put option believes that market price will fall and therefore put will be exercised. Sir, if you want to understand his intention or expectation about share price, just understand when the option will be exercised. Call option will get exercised when market price is higher than the strike price, because call is right to buy. Put option is the right to sell. Somebody will sell share under put option only when market price is lower. So if you understand when the option will get exercised, then identifying this won't be difficult. Writers always want option to be lapsed. So call option, when will it be lapsed? When the share market price is lower, then only option will be lapsed. So this fellow believes that market price will fall. Put option writer believes that market share price will increase in such a way that the holder will lapse the put option. So this is bullish view, this is also bullish view. So expectations over. We have also discussed exercise or lapse decision. This is your positions. Okay. Now, gain oblique loss, or this concept is also called as net payoff. Net payoff to holder, or gain or loss to holder. A payoff formula also could have written, no problem. Great. This is equal to payoff minus premium paid. Holder ki payoff is a kind of inflow, so you can call it as payoff received minus premium paid. Similarly, sir, which option? Let it be any option. Let it be call, let it be put. Holder will always pay premium, payoff he will only receive. So the formula will not change whether it is call or put. Net payoff to the writer. Writer, what is the inflow? Premium received minus payoff paid. Whether it is call option or put option, this formula will not change. Why this formula will not change is holder will always receive the payoff and he will always pay the premium. Writer always premium is inflow, payoff is a outflow. Let it be call, let it be put. That's why. But depending on whether it is a call or put, the manner in which you compute the payoff will change. Payoff formula for call option is different, payoff formula for put option is different. But E formula is not different, it is same because this is net gain or loss formula. Now, payoff. It exists only when option is exercised. If option is lapsed, then benefit is zero, payoff is zero. So payoff in call option is equal to market price minus strike price or spot price minus strike price. A number will be inflow for the holder, outflow for the writer, assuming net cash settlement. Payoff in put option. Sir, put option means right to sell at exercise price. If put has to be exercised, market price should be lower and call option ka strike price should be higher. So it will be X minus spot price. Payoff is benefit to holder, and loss to writer. Because the moment you are writing pay off some number, you are saying that option is excised. If option is excised, writer won't like it. It definitely suffer a loss. Overall, he will suffer a loss. That is different thing. That depends on how much premium he already collected from you. Sir, what we have covered is this entire basics is over, sir. Exchange market, over the counter market. What is the meaning of cash market? What is derivative segment? Cash market ka strategies, stock lending scheme ka steps are over. Understanding what is long position, what is short position. Cash market lo when will you make a gain, when will you make a loss, up to here over. Now coming to options contract. Option ka meaning is one party will have a right, that fellow is called as holder. One party is having an obligation, that fellow is called a writer. So holder, writer. A holder pays lump sum amount to the writer. This is called as option premium, or this is only called as value of option. Therefore, the holder buys the right by paying premium and writer sells the right by accepting the premium. That's why holder of the option is called as buyer and writer of the option is called as seller of the option. Now here you see where confusions will slowly creep in is, see sir, if it is difficult, it is difficult. If it is confusing, it is confusing. But you have to understand all at once. There is no choice here. Carefully observe this. Sir, when I say holder of put option, pause for a moment, think peacefully and tell me this is long position or short position. Peacefully think. From the beginning, whatever we have discussed, think. If you need, turn back the pages what you wrote. We have discussed this. You can turn back the pages if you have written something. This is cash market, options market. Put option means obviously we are talking about option market. Holder. Holder means you have a right. Since it's a put option, you have a right to sell the share. Okay, let's see. That means you have a right to sell the share at a predetermined exercise price in future. My question is, this is called as long position or short position? Long or short? Let's scroll back. Let's see if you have written this or not. Oh, hands are paining. Holder has a right. Holder pays premium. Holder purchased the right. Holder is called as buyer of option, and therefore holder is always called as having a long position. And writer is always called as having a short position. What did he buy? Right he bought, right? And the option he bought. What did he sell? Option he sold. Now come back. Where confusion will come is, the moment we say put option, naturally we will think this. And under this he is selling the share. Since he is selling the share, we will go and be tempted to write short position. Wrong answer. We are talking not about cash market la short sale. We are talking about option market. Option market, you have to think about option buying, option selling, not share ka selling buying. That's why when did we discuss this concept? Even before telling you what is a put or call, I told call or put here. Long position, short position, I told here. Even before telling you what right you have, what obligation you have, we already have put stickers on who is long position, who is short position. Who is long position? Holder. Always, let it be call option, let it be put option. Holder always long position, writer always short position. Because holder, sir, here you should not see what is happening with the share. What is happening with the share you should see in share market, which is cash market. This is which market? Options market. What are we buying? What are we selling? Options we are buying, selling. So buyer of option is called as having a long position. Seller of option is called as having a short position. Who is buyer of option? That fellow who paid premium. Who paid premium? Holder. Let it be call option, let it be put option. Holder always has long position. You should not see what he is doing with the share. You should see what he is doing with the option paper. Clear, sir? So, cash market, there is no option. We were talking only about share directly. So, that's why share if you are buying, we call it as long position. Share if you are selling, we call it as short position. This is not share market, it is options market. So, here what you are doing with the option is important. So, this is wrong, sir. Is correct. Long position. So, always holder of options will have long position. See, if I ask you this, by fluke you will tell correctly. A call option will have a right to buy the share. There anyway buy is there. Holder also is a buyer of option. So if you have to catch this correctly, we have to discuss only this. Okay, now tell me this. This one. Writer of put option. Okay. Writer of call option. Holder of call option. Okay. Let me change it. What is the meaning of this? That's all. Long put option means who are you? I am having a long put position. I am a holder of put option. Okay. I am having a short call. I am a writer of a call option. Language important, sir. Suddenly some question they'll throw up this. You should first understanding if it is correct, answer will come. Here only reversely you think what will happen is where you have to get gain, you will get loss. Where you have to get loss, we will end up getting gains there. So very clearly you must understand. So we understood long position cash, short positions in cash market also, long position, short positions in options market also. Next what is pending is later on when we do futures contract, their long position, their short position will be different. And towards the end we will see all long short in one single table we will make. Cash market what is the meaning of long short, options market what is the meaning of long short, futures market what is the meaning of long short. Are you getting it, sir? It will be very fun. It won't be difficult. It's like you will never get a feeling that we have understood based on that we can solve some. The moment you get that feeling, you start making mistake. So you will get that feeling once entire chapter is over. By then if you walk back and see it, everything looks okay, fine, simple. Now immediately our job is, of course you want a break, that is given. Apart from that, we have to do some questions, some 8 or 10 questions are the small, easy questions. Once we finish off those questions, we will be in a position to understand all these formulas and all clearly. Then there is one small concept called as break-even price. With that, we are done with basics of call and put. So you will understand call, put, maximum gain, maximum loss, when to exercise, when to lapse, what is the feeling of each party at the time of entering, when they will gain, when they will lose, all that full naturally comfort will come. Over options. Now what is difficult in this? If it is only this much. See, all this is confusing to some extent, but imagine we do some 8 to 10 questions on this. Slowly things start getting settled and it won't be difficult at all. Then what is difficult in options? What is difficult is, as I told you earlier, it is valuation of option that is difficult. Till now we spoke about everything except for one thing. When you enter into this contract, you have to pay something to him. A premium calculation entire chapter. The one thing which we did not talk till now, hereafter we'll be talking only about that. The entire chapter is only valuation of that option. A premium calculation, our entire chapter is. That's all. Sir, how much I should pay means it's like whatever you have, 5 rupees is there, please stay. Not like that. There is a proper calculation for that. So entire chapter is only about getting that premium valuation. We use it premium only for writing this formula here. The entire chapter actually is working out this premium, we call it as option ka value. So that is a difficult part. Anyway, we will see. You can take a break.